Hi guys, welcome to my YouTube channel. And hopefully with this video, I can give you all a very clear, thorough, but easy to understand explanation as to what options are.
Okay, so you don't know what options are, and you don't know what derivatives are. And so instead of taking you through a whole textbook definition, which is kind of boring and very easy to get lost in, I'm going to tell you a bit of a story in what I understand it and how I came to learn about it. Because the first time I read the textbook definition, I also thought it was like super complicated. And I also had to read it a few times and then see plenty of examples. It took me a little while to get my head around it. So to start off on, imagine you've got a car and it's worth $25,000. Okay, you would ordinarily you get some insurance for that car, and so that if anything happens to the car, your insurance provider pays you out. You get your insurance policy, and you pay the fee. And just for argument's sake, to make things simple, it's going to be 1 month. You just need insurance for 1 month. So say the fee costs say 300 US dollars for that month. If during that time the car's in a crash, or someone steals the car, or whatever happens to it, you've insured the car for $25,000, and either your insurance provider pays out or it then restores the car's value. So let's assume, yeah, the guy will pay you the $25,000 or will fix your car. The ability to benefit from this asset that you're trying to insure, and if anything happens to this asset, you then get compensated for it. In the options world, that's called a put option. So you buy this insurance policy, you pay a fee, and you insure it for a period of time. In this case, it's a month, and you pay that fee of $300. If during that month something happens to this asset and it goes down in value, your provider will pay you the difference. So you can then use that money to restore your asset to its full value if that's what you prefer. But in your mind and to you, you are indifferent because you are guaranteed that this value of this asset will stay $25,000 because there's someone on the other side who you've paid a fee to restore. So that's what we call a put option in the option space. So now imagine the car could maybe go up in value. Now, yes, that's not possible in the real world, but imagine the car could go up in value, and it went from being a Toyota Corolla, and someone came and gave you a Ferrari in this place, or a Tesla Roadster. So the Toyota Corolla goes from being worth your car goes from being worth $25,000, and now it's suddenly worth $100,000. Similarly, if you had to own, for argument's sake, an insurance policy that if the car had to go up in value, someone would pay you the difference. In this case, it goes from say $25,000 to $100,000. That ability to benefit from a policy where you then get compensated for that difference in value in the option space, that's called the call option. So the ability to benefit from an asset going up in value and someone pays you that difference, that in its most simplest form, the most simplest idea, that's called a call option. Now, in the case of the put option, which I explained earlier on, you don't have to claim on your insurance policy. Obviously, you're going to claim on your insurance policy if something happens to the car. But if you get to the end and nothing happened to the car, the thing's still worth $25,000, you're not going to claim on it. You've lost the fee or that premium you've paid for the period of time that you've insured it. And so another way of saying that, you have the ability to claim. It's your decision to claim on this policy that you own. You don't have to. So to tie this back to the textbook definition, which says a put option gives the holder, which you own the insurance policy. So the put option gives the holder of that policy the ability to sell an asset by a certain date and by a certain price. Okay, the difference here is that in this case you own the car, something happens to it, the provider pays it out. But you could also just decide to walk away because in your mind you are indifferent that this thing is still worth $25,000. You are guaranteed the value of $25,000. So come by the end of it, you get to have your $25,000 asset for whatever reason that you may need. You get to decide you want the $25,000 in value or the underlying asset. You decide. So in the case of a car, the car wouldn't ordinarily go up in value, so you would want to own the put option. But let's say you're thinking about buying a house. Houses go up in value regularly, so you may not have the cash to own or to buy the house. And instead of actually committing to that house, you take out a call option that gives the ability to buy that house at today's value. You may want that ability to decide to take the house or not for 6 months or a year. But say for argument's sake, you say it's a year. If the house was worth $300,000, come a year later, the house is worth $500,000. If you paid $1,000 fee, you're going to want to buy that house because it's now worth more. So the idea of the option is that it gives you this ability to benefit from something going up in value without you having to put down all the capital of that. Okay, so it's an insurance policy again. It's an insurance policy that where you get to be compensated by some asset going up in value without you having to commit that capital. So you get to decide in a year's time whether you want the house, whether you want to walk away, because you paid for that right. It holds it for you, it secures it for you at a specific price, right? So in the case of the car and the put option earlier, it secures the car's value at $25,000 for that period of time. In the case of the house, it will secure the house's value for you at whatever you decided to insure the house's value at. So if the house is worth $100,000 and you may not have the capital, or you want to buy that house in a year's time, or you want to decide whether you want to own the house or not during a year, then you can go buy the option, because if the house is worth $200,000 a year later, and you've been saving up, or you now have the $100,000 to buy the house, you can go put down your $100,000 plus whatever you wrote to the option who committed to pay you out should this house's value go up. They'll pay you the difference, and now you get the house. So you are indifferent to whether the house's value goes up. Now, obviously, if the house goes down in value, you're not going to get anything, and you're not going to exercise that option because the house is worth less now. You can decide what, in this case, what strike. So if the house is worth 100, yes, you can take it out at that $100,000. But if you decide to have it at a higher rate, you also get it at a cheaper price, or you get the insurance policy at a cheaper price. So you may pay $1,000 to insure it for a year at that $100,000 price. But if you decide to, hey, it's only going to cost me $300 or 30% of the fee if I insure it at, let's say, $150,000, you may want to do the lower fee because it saves you 70% of your premium. And then only once that house is worth more than $150,000, then you get to benefit from the policy. Because you might not be able to get the bond, it might take you time to get the bond, and also it's actually a commitment of a large amount of capital. It's the actual capital you have to commit. So if you buy a house, you're committing $100,000 of capital in this case. Right? But for $1,000, you might be able to hold that house's value for you for a year. So it's a much lower capital commitment. And you never know, maybe the house is worth less in a year, then you get to buy it at the cheaper price, or you get to walk away with no admin and no hassle. So a call option gives the holder of the option, you, the right to buy an asset by a certain date for a certain price. In our house example, the house was worth 100,000, and you could want to be able to buy that house by within a year's time, or by the end of a year, by a predetermined price of 100,000. Obviously, the higher you set that price, the cheaper you pay that fee, as I explained earlier. Banks write options on very many different things. It can be on stock, it can be on currencies, it can be on commodities, it can be on any asset that someone's prepared to, or that the bank in most cases is prepared to write to that option on. Just to clarify, on our earlier car example, you don't have to own the car, right? So you can just insure this asset. You don't have to own the asset to be paid out if the asset drops in value. If you do own the asset, then yes, you get compensated for it, but you don't have to own the asset. Same as in the call option. The very last thing I need to mention is that you get two types of options. You get an American option and a European option. In the case of an American option, you can decide at any time during the life of your option when you want to exercise. You get American call options and you get American put options, and you can decide at any point during the time that you want to exercise. So the thing might go up in value, and then, hey, this thing has gone up in value a lot, I want to exercise my call option now. Or in the case of a put option, the opposite. Whereas in the case of a European option, you can only decide at the end whether you want to exercise or not. But you do pay a lot more for the American option in general. For that additional flexibility, you do pay more. So getting back to what is a derivative, this is what we call a derivative. In the case of insurance policy, the value of the insurance policy is, if you had to insure your car, it's dependent on how much the car is worth, or how much you want to insure the car for, and for over how long a period of time, and your particular driving history. So in that case, the insurance policy derives its value from these other things, such as your driving style and the value of the asset. The car is the underlying asset. The car is a real thing. It's a real asset. So the option or the insurance policy derives its value from something that is real. Okay, for that reason, now the basic mechanics of an option stays the same, and it has been the same for like 50 years. Someone in Tokyo can write an option on electricity prices because the electricity prices are real, or on some other commodity, whereas someone in London could write a policy on currency. And so you can create an option, or you can derive this value on any particular asset. It depends on whether the option writer is prepared to do that. Now, there are other instruments which I haven't discussed that you can also use now on platforms such as futures, and I'll talk about that in another video, but they're not the same, and I'll talk about the differences in a future video. But again, the usefulness of the option allows you to pay that fee, and then you always know that your maximum loss is always the fee that you paid.
So to wrap it all up, today we learned what a derivative is, what call and put options are, as well as the different types, American and European options. If you liked the video, please hit the like button and consider subscribing. Thanks.